Investing is key to building wealth and securing your financial future. It involves putting your money to work in assets that can grow over time. However, the world of investing can seem complex and intimidating, especially for beginners. Navigating this landscape requires knowledge, research, and often the guidance of financial professionals. This is where investment companies come in, offering a simplified and more accessible approach to investing. Investment companies act as intermediaries between individual investors and the capital markets. They provide a structured and regulated framework for investors to access a wide range of investment products and services. By pooling money from multiple investors, investment companies can achieve economies of scale, reducing trading costs. One of the primary benefits of investing through an investment company is access to diversification. Investment companies typically offer a variety of investment funds, each with its own investment objective and risk profile. This allows investors to choose funds that align with their individual financial goals, risk tolerance, and time horizon. Unit investment trusts, or UITs, are unique investment vehicles. UITs issue redeemable securities representing an undivided interest in a fixed portfolio of securities. Unlike mutual funds, UITs hold a static portfolio for a predetermined period. One key advantage of UITs is their predictability, making them attractive for consistent income. However, the fixed nature of UITs may not suit investors seeking capital appreciation. Most UITs have a maturity date, at which point the trust is liquidated and proceeds are distributed to unit holders. Exchange-traded funds, or ETFs, offer a versatile and cost-effective way to access a wide range of asset classes. ETFs hold a basket of securities and trade on stock exchanges like individual stocks. This structure combines the diversification benefits of mutual funds with the flexibility of stock trading. ETFs typically have lower expense ratios than actively managed mutual funds, making them attractive for cost-conscious investors. ETFs can be bought and sold throughout the trading day, allowing investors to react quickly to market movements. This intraday trading capability provides flexibility and transparency. Closed-end funds offer an alternative way to access professionally managed portfolios. Unlike open-end mutual funds, closed-end funds issue a fixed number of shares through an IPO. These shares trade on stock exchanges, and their prices are determined by market supply and demand. Closed-end funds can invest in a wide range of asset classes and often specialize in specific sectors or regions. They can trade at a discount or premium to their NAV, creating opportunities for investors. Investors should carefully evaluate the reasons behind any discounts or premiums. In the US, investment companies operate within a specialized tax framework to prevent double taxation. Registered investment companies, or RICs, meet specific requirements and elect to be treated as flow-through entities for tax purposes. This means the investment company itself is not subject to corporate income tax on its earnings. Instead, income and capital gains are passed through to shareholders who report and pay taxes on their share. This flow-through taxation structure is a key advantage of investing through RICs. To qualify for RIC status, investment companies must meet certain requirements outlined in the tax code. The primary benefit of RIC status is the avoidance of double taxation on investment income. This allows investment companies to distribute a larger portion of their earnings to shareholders. To maintain RIC status, companies must derive at least 90% of their gross income from dividends, interest, or gains from securities. Additionally, they must distribute at least 90% of their taxable income to shareholders each year. Failure to meet these requirements can result in the loss of RIC status and adverse tax consequences. The IRS closely scrutinizes RICs to ensure compliance with these rules. Mutual funds offer a convenient way to invest in a diversified portfolio, but this convenience comes at a cost. Mutual funds charge various fees to cover operating expenses, management fees, and distribution costs. These fees can compound over time and significantly impact your investment growth. The expense ratio covers management fees, administrative expenses, and other operating costs. Mutual funds may also charge sales charges known as loads, which can be front-end or back-end. Higher fees can erode investment returns, so investors should look for funds with reasonable expense ratios. Mutual fund fees can be categorized into several types, each serving a different purpose. Management fees compensate the fund's investment advisor for managing the portfolio. Operating expenses cover the day-to-day costs of running the fund. 12b-1 fees cover marketing and distribution expenses and are capped at 1% of the fund's net assets per year. Other expenses include transaction costs associated with buying and selling securities. Not all mutual funds charge all of these fees, so investors should carefully review a fund's fee structure. (12b-1) fees are annual marketing or distribution fees paid by mutual funds to cover expenses related to promoting and selling the fund. These fees are deducted from the fund's assets and can impact investors' returns. The SEC limits 12b-1 fees to 1% of a fund's average net assets per year. Critics argue that these fees can incentivize brokers to recommend funds with higher 12b-1 fees. Some mutual fund companies have moved away from charging 12b-1 fees or have lowered their fees. Investors should review a fund's prospectus to understand how much they're paying in 12b-1 fees and how those fees are being used. The allure of mutual funds lies in their ability to serve as a cornerstone of investment strategies for both novice and seasoned investors. Their popularity stems from a compelling set of advantages that make them an attractive option for a wide range of investment goals. From diversification to professional management, mutual funds offer numerous benefits that simplify the investment process and potentially enhance returns. One of the most significant advantages of mutual funds is their low barrier to entry. With relatively small initial investments, investors can gain access to a diversified portfolio of securities, which would be challenging and costly to replicate by investing in individual stocks or bonds. This accessibility makes mutual funds an ideal starting point for new investors seeking to build a diversified portfolio without committing significant capital up front. Diversification is another cornerstone advantage of mutual funds. By pooling money from multiple investors, mutual funds can invest in a broad range of assets, spreading risk across different sectors, industries, and geographic regions. This diversification helps to mitigate the impact of any single investment on the overall portfolio, reducing volatility and potentially enhancing long-term returns. Moreover, mutual funds are professionally managed by experienced portfolio managers who conduct research, analyze market trends, and make investment decisions on behalf of the fund's shareholders. This professional management relieves individual investors of the burden of researching and selecting individual securities, allowing them to benefit from the expertise of seasoned professionals. This can be particularly advantageous for investors who lack the time, knowledge, or inclination to actively manage their own investments. While mutual funds offer advantages, it's crucial to be aware of their drawbacks. Mutual funds come with risks and limitations that can impact their suitability for certain investors. One primary disadvantage is the potential for underperformance. Poor decisions by fund managers or high expense ratios can erode returns. Another drawback is the lack of control over individual investment selections. Investors delegate decisions to the fund manager, which may not align with their preferences. Fees and expenses can also impact returns, reducing long-term growth. Additionally, capital gains distributions can lead to unexpected tax liabilities. Weighing the pros and cons is crucial when making informed investment decisions about mutual funds. The decision of whether or not to invest in mutual funds is a personal one that depends on an individual's financial situation, investment goals, risk tolerance, and time horizon. By carefully weighing the advantages and disadvantages, investors can make more informed decisions that align with their investment objectives and financial plans. For investors seeking a convenient and accessible way to invest in a diversified portfolio of securities, mutual funds can be an attractive option. Their low barrier to entry, professional management, and diversification benefits make them a suitable choice for investors who lack the time, knowledge, or inclination to actively manage their own investments. However, investors should be mindful of the potential drawbacks of mutual funds, including the potential for underperformance, lack of control over individual investment selections, and the impact of fees and expenses on returns. It's essential to conduct thorough research, compare different mutual fund options, and carefully review the fund's prospectus before investing. Moreover, investors should consider their own investment goals, risk tolerance, and time horizon when evaluating mutual funds. For example, investors with a long-term investment horizon and a higher risk tolerance may be more comfortable with growth-oriented mutual funds, while those seeking current income and capital preservation may prefer more conservative bond funds or balanced funds. Ultimately, the key to successful mutual fund investing lies in understanding the advantages and disadvantages, conducting thorough research, and selecting funds that align with your individual investment objectives and financial plan. A diverse landscape, exploring the variety of mutual funds. The mutual fund universe is vast, offering options to suit financial goals, risk tolerance, and time horizon. Mutual funds are categorized by investment objectives, asset classes, and subcategories. Common asset classes include stocks, bonds, and money market instruments. Stock funds invest in stocks, bond funds in bonds, and money market funds in short-term debt. Subcategories include large cap, small cap, growth, and value funds. This diversity allows investors to tailor portfolios to their objectives and risk preferences. Seeking stability, money market, and fixed income funds. For investors seeking stability in income, money market funds and fixed income funds offer relatively low-risk investment options. These funds invest in debt securities, which represent loans that the fund makes to governments, corporations, or other entities. In exchange for lending money, the fund receives interest payments, providing investors with a steady stream of income. Money market funds are the most conservative type of mutual fund, investing in short-term, high-quality debt securities such as US Treasury bills, certificates of deposit, CDs, and commercial paper. These securities are highly liquid and have very low credit risk, making money market funds a relatively safe place to park cash for short-term needs or as a conservative component of a diversified portfolio. Fixed income funds, on the other hand, invest in a wider range of debt securities with varying maturities, credit qualities, and yields. Government bond funds, as their name suggests, invest in bonds issued by the US Treasury or other government agencies. These bonds are considered to be very safe, as they are backed by the full faith and credit of the US government. Corporate bond funds invest in bonds issued by corporations, which typically offer higher yields than government bonds, but also carry higher credit risk. Investors seeking higher yields within the fixed income space may consider high-yield bond funds, also known as junk bond funds. These funds invest in bonds issued by companies with lower credit ratings, which means there is a greater risk that the issuer may default on its debt obligations. However, the higher yields offered by these bonds can potentially compensate investors for the increased risk. Targeting growth equity and hybrid funds. Equity funds invest in stocks for long-term growth. When companies perform well, stock prices rise, generating gains. Equity funds vary by investment style and sector. Growth funds target companies with high earnings potential, often in tech, healthcare, or consumer sectors. Hybrid funds mix stocks and bonds for balanced growth and income. Allocation varies by fund's objective and risk profile, suitable for diversification and hands-off investment. Investing wisely. Your journey to financial well-being. The world of investment companies offers diverse options to grow your wealth and secure your financial future. From unit investment trusts to ETFs, closed-end funds, and mutual funds, there's an investment vehicle for every risk tolerance and goal. Successful investing requires understanding your financial needs, conducting research, and evaluating risks and rewards. Investment companies simplify the process, offering diversified portfolios and professional expertise. Approach investing with a discerning eye, considering fees and expenses. Seek guidance from qualified financial advisors to navigate the investment landscape. Investing is a journey, not a destination. It requires patience, discipline, and a long-term perspective. Stay informed, diversify, and focus on your financial goals to build a secure future.